I'm not in the camp that says gold is signaling some big event because, frankly, I'm looking for a big event next year. Global bust, the worst financial crisis in maybe history, but certainly the worst downturn in 80 or 90 years, since the Great Depression in a lot of ways, bigger than 2008-9. So I'm looking for something like that. I don't think that's what gold's sniffing out. I think gold is sniffing out that the dollar is even though it's been strong of late, the dollar is basically headed lower. I think gold is sniffing out that there's certainly still turmoil geopolitically out there with Ukraine and Russia, and we're not sure what's going to come out of Gaza. I think gold is more than anything probably um, technically strong, and so it brings in a lot of buyers. I think that's everybody tries to read so much into these moves, but gold broke out and it's continued to be very strong. And when you look at the charts, it looks very strong. And the institutions again have very little gold. I mean, the central banks have been buying it, but institutional investors did not allocate to gold. They said, "Oh no, it's not really where we want to be." And now you're starting to hear just in the last month some big investors saying you should have 10 or 20% of your portfolio in gold because of the momentum. I mean, they can come up with the rationales, but why are they interested in it? Because it's up. And that's, I think, momentum's going to get momentum, and you're going to see it a lot higher. I raised my target on gold in my October letter from 4,000 to 5,000, and that's a pre-bust target. So in the next 3 to 6 months, um, I raised my target on silver from 75 to 100. I was already pretty high on the street at 75, and I raised it to 100. And again, in that same time frame. So they're particularly strong. They had big runs, and obviously he got hit very hard this week. I see this as nothing more than when you're in a steep rally, your corrections are also steep, what I call um, short and sharp. And I think we probably have seen the full correction already. It's possible you could get a second shoe dropping, but more than likely that event on what was it, Monday or Tuesday, um, was all you're going to get.
Speaking of the event on, well, recent events, but
Yeah.
speaking of near term volatility, I found it really interesting. I was running a study on shorter duration index realized volatility. Obviously, I'm an options trader, so I spend a lot of time looking at forward vol. But I find it really interesting to see volatility on average has increased pretty massively over the last decade or so, just on average. And this isn't looking at necessarily VIX outright, which again is more forward, but looking at realized ranges. What do you make of that effect? Just this general change in the way that the market seems to react to information. And it seems like it can really get pretty jittery off of just about anything. And then it's kind of like trying to attach a talking point to it, right? Like, oh, Zion Bank had a couple, fraudulent credit lines that they're litigating for. So now financials crater. It seems really, really volatile comparatively to 10, 15 years ago.
Yeah, well, you're talking to somebody who back in the early years of my portfolio management times, we didn't get news so quickly. And I was an institutional money manager, but we didn't even have quote machines on our desk. I had to go out in the hall to look at one. And it was really a time when you poured through, I think they came quarterly. There was a technical analysis service out of Boston that sent a bound book of charts, and it came once a quarter. And you poured through those because it was fun to look for stocks. All that stuff's at your fingertips today. So, and it's at the retail investors' fingertips. And there's, the retail brokers have all kinds of trading tools that you can use, et cetera. There's trading services out there. The news is right there to the minute. You know, you can get it on Twitter, or you can get it on Bloomberg, or you can get it somewhere else. So, you know, for somebody who kind of grew up in a time when we really weren't so attached to news, this has been happening all along. You know, it's been getting faster and faster. Um, but it's also, I think, because of where we are in the cycle. You know, you're so late in this cycle, and it's been literally 43 years in a bull market, a secular bull market cycle, and certainly, um, you know, a long stretch from 2008-9, even though we did have a short bear market in 2022. I just think it's the nature of the beast that as you get steeper, you're going to see more volatility. You know, in a lot of ways, if you remember, there was a lot of talk about how there was so little volatility just a year ago or
Mhm.
whatever. And it was just kind of almost every day it was up. I think we're going to see volatility in a big way over the next year. Um, you know, it was one thing I will say is the VIX, the way the VIX acted here while the market was moving up, the VIX was moving up, and that's unusual. And I'm not sure exactly what that was about. You probably have a better handle on that than I do, but um, I don't read too much into that. I don't think it means danger sign. I just think volatility has gotten, at least the VIX index has gotten so low. When we got a little nervousness there, it translated pretty quickly into the VIX.
It's actually really funny because when I was looking at the analysis, a big thing that I compare is variance risk premiums. So the relationship between implied vol forward looking and then realized vol, what's happened. And it is ironic because realized vol is trended high and VIX forward looking vol specifically for S&P is trended low. So we find ourselves in this very weird scenario. I definitely actually spend a lot of my time trading vol because, at least to me, that can be a little bit more predictable than other stuff. But the other thing I find really interesting and what your thoughts are on are the correlation between specifically gold, but I would say metals in general and the indices. A lot of people build portfolios on these really long term standard relationships that sometimes can get skewed. But what do you think of the relationship right now between gold and S&P, or, pick an index of your choice?
Yeah, because we have talked pretty much quarterly for the last year anyway, and talked for the last couple of 2 or 3 years, but quarterly really this year. I think I've been pretty consistent in saying everybody thinks stocks and the metals have to move opposite, or stocks and gold have to move opposite or inverse relationships. And I've consistently said what we're going to see in this last run to the top is that they're all going to play. Stocks are going to play, the metals are going to play, the bonds are going to play. And that's another thing. Everybody saw it, the bond market move up when the stock market moves down. I said, no, you're going to have rates coming down. That'll propel the stock market. It'll also propel the metals market. And that's what I think you're seeing. And I think you're going to see it in spades here in a much bigger way in the next few months. I mean, I'm expecting the 10-year to fall to 3% or below in the next 3 to 6 months, probably closer to three, but I don't know. Um, and the metals, I think my targets could be hit as early as January. $100 on silver, 5,000 on gold, maybe even sooner. If it really gets going here. So I think you're going to see what we've seen in recent months is only going to get more dramatic. And obviously, my stock market call is for this thing to go parabolic and basically vertical.